Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, today we're going to break down a true trading classic, Dr. Alexander Elder's The New Trading for a Living. Now, this isn't just another book about how to pick the next hot stock. Nope, this is a deep dive into conquering the one thing that causes most traders to fail, and trust me, it's probably not what you think.
So let's just start with the biggest, most important question of all. Why do so many traders lose money? It's a tough reality, right? But figuring out the why is the absolute first step to making sure it doesn't happen to you. Because here's the secret. While the markets can be tricky, the real enemy, it isn't out there. It's in here.
And this quote from the book just hits the nail on the head. What Dr. Elder's really saying is that the #1 reason traders fail has nothing to do with a bad system or not having enough information. It's all about our own psychology. It's that powerful, very human habit of seeing what we want to see on the charts instead of what's actually there. The real fight isn't with the S&P 500, it's with ourselves. So, let's tackle this problem head-on. Section 1, the emotional roller coaster. Because this, right here, is where pretty much every trader's journey begins. And for many, where it ends. Sound familiar? You nail a winning trade, and suddenly you feel like a genius, totally invincible. Then you take a loss, and it feels like a personal attack, a total gut punch. Amateurs get stuck on this ride, bouncing between the high of a win and the low of a loss. And when you're on that roller coaster, you're not in control, you're just reacting. And that chaos, that's what leads to breaking your rules and, ultimately, blowing up your account. I love this analogy because it's just so perfect. Emotional trading isn't just a bad habit, it is lethal to your account. Think about it. A scuba diver would never get careless with their air tank. Why? Because it's their lifeline. For you as a trader, your capital is your air supply. Once it's gone, you're out of the game, period. So your first job, your most important job, is to protect it at all costs. Okay, so if being emotional is the problem, what's the solution? Well, that brings us right to Section 2, the real key, which is all about psychology. This right here is the central message of the entire book. The market is just the market. It's totally neutral. It doesn't know you exist, and it certainly doesn't care. The real opponent, the one who messes things up with greed, fear, impatience, is you. It's the person staring back from the mirror. So to win, Dr. Elder says, you have to study yourself with the same focus you use to study a chart. And this requires a huge mindset shift. You see, amateurs are obsessed with forecasting. They're always trying to predict the future, looking for that magic crystal ball. Professionals, they focus on managing. They respond to what the market is doing right now. They don't need to know the future because they have a plan to react to whatever happens. That's why how you manage a trade is so much more important than what you trade. So what about all those fancy charts and indicators? Well, this perspective is a real game changer. Technical analysis isn't some mystical tool for telling the future. It's just applied social psychology. A price chart is nothing more than a picture of the collective emotions, the hope, greed, and fear of millions of people. When you use an indicator, you're not predicting anything. You're just taking the temperature of the crowd. Okay, this all leads us to the core, actionable strategy of the book. Section 3, the 3 pillars of success. This is the blueprint for actually building a solid, long-lasting trading career. Dr. Elder calls this his 3-legged stool. You've got mind, method, and money. You absolutely need all 3 to stay balanced and successful. If you try to kick out even one of these legs, the whole thing comes crashing down. So let's quickly break down each one. First up, the mind. This is all about being a stone-cold realist. It means you're constantly checking in with yourself. Am I putting this trade on because my system says so? Or am I just feeling a little greedy after a couple wins? Am I holding on to this loser because I'm afraid to admit I was wrong? A pro trader doesn't get excited and they don't get depressed. They just stay focused and execute. Pillar number 2 is your method, your logical trading system. This means you need to have clear, written-down rules for everything. When do you get in? What specifically has to happen on the chart? Where does your stop-loss go, with no exceptions? Where do you plan to take profits? The goal isn't to find some magic system that never loses. The goal is to have a consistent process that takes all the emotion and guesswork out of it. And finally, we get to money, or risk management. And let's be honest, this is the pillar that holds everything up, and it's the one most amateurs totally ignore. You can have the greatest system in the world, but if you don't have strict risk management, one bad losing streak can, and I promise you, will, wipe you out.
For a professional, survival is always priority number one. In fact, risk management is so critical, we're going to dive a little deeper. Section 4, Mastering Risk, Mastering Yourself.
So how do you actually put this into practice? The book gives us a fantastic tool called the Iron Triangle of Risk Control. It's basically a framework that forces you to structure every single trade around survival, making sure your trade setup, your risk controls like stop losses, and your overall money management plan are all working together. And at the heart of all this are two rules you just cannot break. The first is the 2% rule. This means you can never, ever risk more than 2% of your total account equity on one single trade. Now, that doesn't mean you buy 2% worth of stock. It means you calculate your position size so that if your stop loss gets hit, the actual dollar amount you lose is no more than 2% of your account. This one rule makes it mathematically impossible for a single bad trade to destroy you. The second rule is the 6% rule. Dr. Elder calls this the shark rule. If your total net losses for the month hit 6% of your equity, you stop. You're done. You close everything and you do not place another trade until the first day of the next month. Think of it as a circuit breaker for your account. It protects you from yourself when you're in a slump and prevents that emotional death spiral of revenge trading. And really, this all boils down to that classic Wall Street saying, bulls make money, bears make money, but hogs get slaughtered. It's fine to be bullish, it's fine to be bearish, but it is never okay to be a hog, to get greedy. Greed is what makes people break their rules. The 2% and 6% rules, they're there to protect you from your own inner hog. So you've got the three pillars: mind, method, and money. How do you tie them all together and make sure you're actually getting better? Well, that leads us to our final section, becoming your own teacher. Dr. Elder actually introduces a fourth factor, and it's the glue that holds everything else together: meticulous record keeping. Seriously, keeping good records is what turns random, chaotic experience into structured, valuable learning. It's how you find your weaknesses and systematically improve them. Your trade journal is the most honest coach you will ever have. When you record every single trade, not just the numbers, but your reasoning for getting in and out, your emotional state, maybe even before and after screenshots of the chart, you create this undeniable feedback loop. You start to see your patterns, good and bad. This is the discipline that turns you from just another person clicking buttons into your own best teacher. And all of this leads to a final, really important idea. Trading isn't some destination you just arrive at one day. It's not a puzzle you solve and then you're done. It's a continuous journey of analyzing the market and, even more importantly, constantly analyzing yourself. So I'll leave you with the question that lies at the very heart of this book. As you're looking at all the charts, the indicators, the news, are you spending that same amount of time and energy looking in the mirror? Because according to Dr. Elder, that's where the real work is done. That's where mastery truly begins. All right, let's talk about the single most important part of trading. And, it's funny because it's also the one thing most people completely ignore. We're not talking about charts or some secret formula. We're talking about what's going on right between your ears. It's all about psychology. So let's dive in. So here's the big question, right? The one that hangs over everything. Why do so many smart, motivated people jump into the markets full of hope and just get wiped out? It's a question every single one of us has probably asked at some point. And look, let's just get this out of the way right now. The answer is not what you think. It's not because they didn't find the perfect indicator or some holy grail trading system. The real reason people fail is, well, it's a lot deeper and a lot more personal than that. To really understand why things go so wrong, first we have to look at what pulls people in. I mean, what is it about this incredibly difficult game that makes people want to play in the first place? It really boils down to a very powerful, very human dream. And man, is the dream seductive. You can see the appeal, right? The idea of making a ton of money and fast. The freedom to work from anywhere, to be your own boss. Plus, it's sold as this ultimate intellectual puzzle, a mix of chess and high-stakes poker. It's the perfect challenge for anyone who loves taking risks. But, and you knew there was a but coming, right? This is where that incredible dream smacks right into a brick wall of reality. This is where fantasy, all these destructive myths, and ultimately failure crash the party. And here's the crazy part. It often starts out great. A new trader makes a few good calls, and suddenly they feel like a genius. They feel invincible. And that feeling? Oh, that feeling is the most dangerous drug of all. It makes you feel like you can't lose, so you start taking crazy risks and living in a fantasy world. Which leads us straight to the first big myth. So after a few losses start to pile up, the first thing people tell themselves is, okay, I'm just missing something. There must be some secret the pros know that I don't. And that idea, well, it fuels an entire industry of so-called gurus happy to sell you their secrets.
But here's the thing, it's just not true. Our source material is crystal clear on this. The winners aren't all geniuses with PhDs, and the losers aren't dumb. A lot of incredible traders never even finish college. The real difference is somewhere you'd probably never think to look.
Okay, myth number 2. This one is a classic. After taking a big hit, the trader says, I knew it. The trade turned around right after I got stopped out. If I just had a bigger account, I could have held on and made a fortune. Sound familiar?
But it's just an excuse, isn't it? It's a way to avoid the real, painful truth about not managing your risk. The problem isn't the size of your wallet, it's the state of your mind. A trader with no discipline can blow up $1 million account almost as fast as a $1,000 one.
And then we have the ultimate fantasy, the autopilot myth. This is the dream of finding that one perfect automated system that does all the work for you. You just turn it on, head to the beach, and watch the money roll in.
But think about that for a second. Airlines have had autopilots for decades, but they still have 2 highly paid pilots up front. Why? Because you need a human to handle the unexpected. And the market? Well, the market is pretty much all unexpected events. Relying on a rigid robot is just a recipe for a fiery crash.
So when you chase all these myths, you live in these fantasies, it all leads to one inevitable destination, and it's a really, really painful one. The source for this explainer calls it hitting rock bottom. So why is it so easy to completely self-destruct in the markets? It's because the market is nothing like real life. Out there in the real world, we have safety nets. People try to avoid hitting your car. Your friends might warn you if you're about to do something stupid. But the market? It's the complete opposite. It's a demolition derby where everyone else is actively trying to profit from your mistakes. There's nobody there to save you.
And rock bottom isn't just having a bad day. We're talking about that gut-wrenching, unbearable moment when you lose money you needed, like for rent. It's that moment of horrifying clarity when you can't lie to yourself anymore and reality just completely shatters your denial.
Now, for most people, that's it. Game over. But for a tiny few, hitting rock bottom is actually the beginning. It's the start of a total transformation. And it all begins by looking at the problem in a completely new way.
So I want you to really let this sink in. All that time you spent looking for better charts, better systems, it all misses the point. The reason you lose isn't a technical problem.
The real problem is that it's an addiction to the thrill, to the high of being right, and this uncontrollable urge to be in the action, even when you know it's destroying you. This one idea, it changes the entire game. And this isn't just a clever analogy, it comes from the author's own life. He was a psychiatrist and he went to an Alcoholics Anonymous meeting and had this incredible aha moment. As he listened, he realized they were describing his trading perfectly. The denial, the inability to stop, all he had to do was replace the word alcohol with the word loss, and it was a perfect match.
Okay, so if the problem is addiction, that's huge. Because it means the solution isn't some trading secret buried in a chart. It's a recovery plan, and we can actually model it on one of the most successful recovery programs in history.
And that path starts with 3 very clear steps. First, just like in AA, you have to admit you have a problem you can't control on your own. Second, you stop acting like a gambler and start acting like a business owner by defining exactly what you stand to lose on every trade. And third, you follow one ironclad rule. You never, ever risk more than 2% of your account on any one trade. That rule right there, that's the one thing that will keep you in the game.
Now this next part is going to sound completely backwards, but stick with me, because it's the most important mental shift you can make. An AA member says, I am an alcoholic every day to stay vigilant. A trader needs to admit, I am a loser, to remember that they have self-destructive impulses. It's not about feeling sorry for yourself. It's about admitting you have a weakness, so you can build the discipline and strength to control it.
So after all of this, what does the other side actually look like? What really separates the trader who makes it from the one who keeps struggling? Let's look at the mind of a pro. It's a huge contrast. The loser is just an emotional gambler, riding the highs of a win, getting crushed by the lows, always chasing the thrill. The winner, on the other hand, is a calm professional.
they stay emotionally flat. They focus on their plan. And most importantly, they know they can't control the market, so they focus on the only thing they can control, themselves. And look at the goal. The loser's goal is to make money, which makes every decision emotional. The winner's goal is just to trade well. The money, that just comes as a result of doing the right things, over and over again.
And maybe this is the best way to sum the whole thing up. Think of the market as this vast, powerful ocean. You can't control it. A good sailor doesn't try to control the ocean. They respect it, they study the currents, and they focus all their energy on controlling their own ship. That's what a professional trader does.
So in the end, it really all comes down to this. The market is completely, totally indifferent to you. It couldn't care less if you make $1 million or blow up your account. It was here long before you, and it'll be here long after you're gone. The only person on this planet who truly cares, the only one responsible for your survival and success, is you. So I guess the only question left to ask is, do you?
You know, when you think about what really moves the markets, it's so easy to get lost in all the numbers, right? The charts, the earnings reports, the economic data. But today, we're going to go deeper. We're going to explore the powerful and, let's be honest, often irrational mass psychology that is the real engine behind every single market trend. It's time to pull back the curtain on the mind of the market. So here's our game plan. We'll start off by meeting the classic characters of the market in what's known as the Wall Street Zoo. Then, we're going to completely redefine what a price actually is. From there, we'll zoom out to see the mind of the market crowd, compare the power of the big institutions versus us individuals, and wrap it all up with a timeless strategy for survival. All right, our first stop is the Wall Street Zoo. And it's a funny name, but it actually comes from a real wall that was built to keep farm animals in Manhattan, believe it or not. That farming legacy, it lives on in the language traders use every single day. And honestly, it's the perfect metaphor for all the different mindsets at play. Okay, so at the very heart of any market, you've got this fundamental conflict. On one side, you have the bulls. They're the optimists, betting that prices are going to rally. On the other side, you've got the bears, the pessimists, betting on a decline. This constant battle, this tug of war between buying and selling, that's what creates every single move in the market. But the battle isn't just between the bulls and the bears. Oh no. Meet the hogs. These are the greedy traders. They get themselves into trouble in two ways. Either they risk way too much on a single trade, or they hold on for dear life way after a trend has reversed, just hoping for a little more profit. And in the market, well, greed is a one-way ticket to getting slaughtered. And then there are the sheep. These are the passive, fearful followers. They don't have a plan, they just follow the herd, right? They jump on trends way too late, they listen to tips from so-called gurus, and they just start bleeding pitifully the second the market gets volatile. What they lack is independent thought, which is absolutely crucial for survival. You know, there's this classic Wall Street saying that just sums it all up perfectly. You can make money as an optimist or a pessimist, a bull or a bear. That's fine. But if you let greed or that herd mentality drive your decisions, well, the market is an incredibly unforgiving place. Your behavior has a direct impact on the outcome. And it all starts with how we create a single price. So this brings up a really fundamental question. We see prices flashing on our screens all day long. But what is a price, really? It's not just a number. It's the result of a psychological battle that's being fought every single second of every day. So every market, and I mean every market, can be broken down into these three groups. You've got the buyers and sellers, and they're in direct conflict over value. But the real key group here, the one that changes everything, is the undecided traders. They're the ones just standing on the sidelines, and their presence creates this incredible sense of urgency for everyone else. So here's how it works. You've got the conflict between buyers and sellers setting the stage. Then the pressure from that undecided crowd makes both sides a little more anxious, a little more willing to act because they're afraid they're going to miss out. And then finally, when an eager buyer meets an eager seller, bang, a trade happens. And that one transaction creates a single price point, a momentary consensus. So I want you to think of it this way. A price is not some static, objective value. Not at all. It is a fleeting agreement, a little snapshot of the collective psychology of every single participant at one specific moment in time. It is pure mass psychology in action. Okay, so now that we understand how a single price gets formed, let's zoom out. Because the market isn't just a few people, it's a massive, global crowd. And when we, as individuals, join this crowd, our thinking changes in some really profound and often dangerous ways. And this is not a new idea. As the Scottish writer Charles Mackay observed nearly 2 centuries ago, the madness of crowds has been around forever. He wrote about things like the tulip mania, where people lost entire fortunes betting on, well, tulip bulbs. It just goes to show, when we act as a group, we often leave our reason at the door. The social psychologist Gustave Le Bon, he figured out exactly how we change. He said that when we join a crowd, we become part of a collective mind. We're suddenly more likely to believe anything, to act on pure impulse, and to look around for someone, anyone, to tell us what to do. Our emotions completely take over, and our ability to think for ourselves just vanishes. This right here, this is the exact psychological state that gives birth to the sheep we were talking about earlier. So, if this massive emotional crowd is desperately searching for a leader, who do they follow? Is it the gurus, news anchors? The answer is actually pretty surprising. They follow price itself. That constant stream of upticks and downticks on the screen, that becomes the commander that everyone is watching and reacting to. Price exerts this incredible psychological force. When a trade is going your way, it feels amazing, right? It feels like a rewarding parent encouraging you, telling you you're smart. But when it goes against you, it feels like a punishing parent, and it triggers fear, anger, panic. We stop thinking rationally, and we just start reacting emotionally to our leader. So here you are, an individual trying to navigate this giant emotional crowd that's being led by price. But you're not alone in there. You're competing against giants, these massive institutions with incredibly deep pockets. And understanding this dynamic, it's absolutely critical to your survival. I mean, just look at the contrast here. It's stark. Institutions pay almost nothing in commissions. They have access to private intelligence networks. We're talking former intelligence officers, people on the ground. And psychologically, they're playing with the firm's money, not their own life savings. It looks like an impossible fight, but look at that very last row. Because here it is. Here is the giant's critical weakness, their Achilles heel. A bank has to be in the bond market. A pension fund has to be invested in stocks. They have mandates, they have client pressure that forces them to trade, to be active, almost all the time, even when conditions are terrible. And that right there, that is your greatest weapon. As an individual, you are under zero obligation to do anything. You can wait patiently for the perfect setup. You can sit on the sidelines with your cash while the bulls and bears beat each other up. This freedom, this ability to do nothing and trade only when the odds are stacked in your favor, it's a superpower that most individuals just throw away. And this brings us to our final and honestly most important section. If the market is a sea of overwhelming emotion and your own psychology is your weakest point, how do you survive? Well, the key isn't to predict the future, it's to control yourself in the present. There's a perfect metaphor for this from Greek mythology. Odysseus, he wanted to hear the siren's song, which was beautiful but also deadly. He knew that if he heard it, he'd be tempted to jump overboard to his death. So what did he do? He had his men tie him to the ship's mast. He got to experience the temptation, but he was physically powerless to act on his impulse. Your trading plan, that is your mast. It's what you create when you are calm and rational before you enter the emotional storm of the market. It has to define exactly when you will get in, exactly when you will take profits, and most importantly, exactly when you will cut your losses. And here's the rule. Once a trade is on, you cannot change the plan. You must tie yourself to it. So when you boil it all down, successful trading really stands on 3 pillars. Yes, you need a solid method for analyzing the market. Of course, you absolutely need strict rules for managing your money. But guess what? Neither of those matter without the 3rd pillar, the discipline to control your own mind and stick to your plan. Psychology is the foundation of everything. And that leaves us with one final thought. We often think of trading as a battle against other people, right? Against this faceless crowd. But after everything we've talked about today, it's really worth asking, is the market just a mirror? Is it possible that the real and maybe the only battle is the one you fight against your own impulses?
You know, what if you could read the minds of every other trader in the market? Sounds a little like a superpower, right? Well, in a way, that's exactly what classical chart analysis is all about. We're not just looking at lines on a screen, we're looking at a living record of crowd psychology. Today, we're going to pull back the curtain and learn how to read the emotional story that's hidden in every single stock chart, so you can make much smarter decisions. All right, let's get into it.
This quote just hits the nail on the head, doesn't it? It perfectly captures the single biggest challenge in chart analysis: ourselves. Our brains are literally wired to see patterns, even when they aren't really there. We look at a chart and project our own hopes for a breakout or our fears of a crash right onto the screen. So before we can even begin to read the market's mind, we've got to learn how to quiet our own.
So here's our game plan for this explainer. We're going to start by looking in the mirror to understand our own biases. Then we'll decode the incredible story told in just a single price bar. After that, we'll uncover the market's painful psychological memories, and then really get into the two completely different playbooks for trading. By the end, you'll be able to spot the market's most reliable signals and find those moments of pure order in all that chaos.
So, how do we actually fight back against our own biases? Well, the first step is just admitting we have them, dragging them out into the open. So let's dive into the psychology of this Rorschach test and see exactly how our minds can play tricks on us when we're trading.
Come on, you've totally fallen into this trap before, right? I know I have. You stare at a chart and you are just convinced it's about to blast off. But is that feeling coming from the actual data on the screen, or is it just your own hopes and fears doing the talking? That's the core problem. Unlike some computer indicator that gives you a number, these classic patterns are more of an art, and it's in that ambiguity that our biases love to hide.
And here's where it gets really, really interesting. We've all drawn diagonal trend lines, but what if I told you they're basically a tool for self-deception? Think about it. You can connect the highs or the closes or the lows, and each line tells a totally different story. Usually it's the one you wanted to hear in the first place. The author argues that the market has a terrible memory for diagonals. What it does remember with perfect clarity are the concrete horizontal price levels where fortunes were made and lost. That simple idea is a real game changer.
And that's why this Buffett quote is just so perfect. It's a great reminder that the market isn't some cold, logical, perfectly efficient machine like you read about in textbooks. No way. It's a messy, emotional, living thing, driven by the collective hopes and fears of millions of people, a giant crowd. And it's those powerful, predictable human emotions that create the patterns we can actually see and trade.
Okay, so how do we start to read those emotional patterns? Well, it all starts with the most basic building block of any chart, a single price bar. You have to see each and every bar as its own little story, a microcosm of the entire market. It's a complete tale of a battle fought between the bulls and the bears over a specific amount of time.
Every price bar gives you 4 key pieces of data: the open, the close, the high, and the low. But these are not just numbers. You should think of them as clues, like fingerprints left at a crime scene. They reveal the entire psychological drama that unfolded during that trading session. Let's break them down one by one.
Let's start with the open. You can pretty much think of the opening bell as amateur hour. Seriously, this is when all the retail traders, they're fueled by the morning's headlines and maybe a cup of coffee. They rush to place their orders before their real job starts. This creates this huge flurry of emotional buying or selling right at the bell, which, by the way, can be a fantastic opportunity for the pros who know how to read it. And that's where the professionals come in. See, they've been watching the market all day long, just letting the amateurs exhaust themselves. They use that final hour of trading when the real institutional volume comes in to make their move and deliver their final verdict on the day's price. So if the close is way higher than the open, that's a huge sign that the smart money is siding with the bulls. The takeaway here is simple. Always try to trade with the pros.
Now, the high of the bar, that's the bulls' last stand. It is the absolute high watermark of their power. They pushed, and they pushed with everything they had, but at this one exact price, their buying power just completely ran out of steam. It's a clear signal that buying pressure is fading, a line in the sand drawn by the sellers.
And the low of the bar is the exact same thing, just the mirror image. It's the bears' last gasp. It's the point where they've thrown every single sell order they could at the market, but they just couldn't push the price down one more tick. This is a crucial signal that selling pressure is finally drying up, a line in the sand drawn by the buyers this time. Okay, so we've learned how to read the little short story told by a single price bar. Now, let's zoom out and see how thousands of those little stories combine to create the epic, emotional saga of the market. And we do that by talking about support and resistance, probably the two most important concepts in all of technical analysis. And it really is as simple as this. Support is the floor and resistance is the ceiling.
When prices fall and hit that floor, they tend to bounce back up. When they rise and smack into the ceiling, they tend to fall back down. Understanding where these psychological floors and ceilings are is absolutely key to figuring out what the market might do next.
All right, now this is where things get really cool. These support and resistance levels, they aren't set in stone. They can actually switch roles. As you can see right here on these charts for Netflix and for gold, a price level that was a stubborn ceiling for years can, once it's finally broken, become a brand new solid floor. It's like the market has this powerful memory, and it's constantly remembering and adapting to these key price zones.
And let's be crystal clear, these are not magical lines on a chart. They are a map of our collective human emotion. I mean, we've all been there. You're holding a losing stock and you're just praying for the price to get back to what you paid for it so you can sell and just get out, just escape the pain. Or maybe you missed a huge rally and you're kicking yourself, promising you'll buy if it ever dips back to that level. It's that intense feeling of pain and regret multiplied by thousands and thousands of traders that creates these powerful zones.
So how do you know if a support or resistance level is the real deal, or if it's just a little blip? Well, it all comes down to three things that measure how much emotional energy was spent there. First, it's length, meaning how much time the price spent in that zone. Second, it's height, or how wide the price zone is. And third, it's volume, how many shares actually traded hands there. The more of each, the stronger and more significant that psychological memory becomes.
Okay, so we figured out how to identify these psychological floors and ceilings. Now we need to learn how to actually trade around them. And this brings us to the two fundamental states of any market. It's either trending up or down, or it's stuck going sideways in a range. And knowing which state you're in, well, that's often the difference between making money and losing it.
You have to think of it like playing two completely different games with two totally separate rulebooks. When you're in a trend, your job is just to ride the wave. You buy into strength, you sell into weakness. But in a range, you're trying to do the exact opposite. You fade the extremes. You sell when prices get near the ceiling, and you buy when they get near the floor. The strategies are polar opposites, and trust me, if you get them mixed up, you are going to get absolutely crushed.
All right, so we know how to play in trends, and we know how to play in ranges. Now let's talk about how to spot the exact moment a trend might be about to die, or a range is about to break. These are those powerful turning points, the moments of maximum opportunity that can really make or break a trader.
Oh man, this is such a classic rookie mistake. You see the price finally punch through a long-term ceiling, and you jump in with both feet thinking you're about to make a fortune. But then, just as quickly, the price comes slamming right back down, and you're left holding the bag. This is what's called a false breakout. It's one of the most common and painful traps in the market. But for professionals, it's one of the most reliable signals to trade against all those trapped amateurs.
And that leads me to one of my absolute favorite patterns. It's called the kangaroo tail, and it's a dead giveaway that a big, violent move in the opposite direction is probably coming. It's a single, very long price bar that just leaps out from the rest of the chart, just like a kangaroo's tail. It's this beautiful visual sign that one side, either the bulls or the bears, tried to make an aggressive move, but they failed miserably and got slammed right back into the range.
And it really is this simple. If the tail points up, like you see on the left, it was a failed bull raid, and that is a powerful sell signal. If the tail points down, like on the right, it was a failed bear raid, and that's a high probability buy signal. It's one of the most objective and reliable patterns out there, and it can be incredibly profitable if you just learn how to spot it.
So we have covered a lot today. We've learned how to read the emotional story inside a chart, how to identify the market's painful memories at support and resistance, and how to spot its most reliable signals of failure and reversal. So now let's put it all together and see how we can use this knowledge to become a more clear-headed and hopefully more profitable trader.
So what's the bottom line here? Look, trading isn't about predicting the future with a crystal ball. It's about patience, it's about discipline, and it's about understanding human psychology. It's about waiting for all that market chaos to finally settle down and resolve into one of these clear, orderly patterns we've talked about. If you can learn to read the emotional story in a chart, and this is the most important part, learn to control your own emotions, you will be well on your way.
And this is the one question I really want to leave you with. Are you trading the market, or are you trading people? When you really stop and think about it, the two are exactly the same thing. The market is nothing more than a giant reflection of our collective hopes, our fears, our greed, and our regrets. And if you can learn to understand those emotions in others and manage them in yourself, you can learn to master the market.
Today, we're going to dive into the incredible journey of trading analysis. We're talking about the massive leap from the old-school world of drawing charts with a pencil and paper to the lightning-fast digital age we live in now. And you'll see how this revolution wasn't just about speed, it completely changed the game for how traders see and interact with the market.
You know, this quote just hits the nail on the head. I mean, think about it. If you're on a bike, sure, you might enjoy the scenery, but you're moving slow, methodically. In the world of financial markets, where things change in a heartbeat, being on a bicycle is just not going to cut it. You need the horsepower of a sports car, and that sports car is your computer. It's all about speed, power, and the ability to process a mind-boggling amount of data in seconds.
All right, so here's the plan for today. First, we're going to take a trip back in time and see that jump from paper to pixels. Then, we'll talk about something absolutely crucial, the difference between toolboxes and magic boxes when you're picking your software. From there, we'll start decoding the market's language using indicators, starting with a classic, the moving average, and then we'll really level up with some advanced signals from MACD and divergences. So let's kick things off with the revolution itself. It's kind of hard to wrap your head around it now, but there was a time when every single chart was drawn by hand. The arrival of the personal computer just blew the doors off everything, turning what was a manual craft into a digital science. You know, the author of our source material shares this amazing personal story that really puts it all in perspective. His first trading computer was an Apple IIe, and get this, it had 2 floppy drives. One was for the program itself, computerized, and the other was for the market data. And when hard drives finally came out, he bought a 5-megabyte one, thinking the 10-megabyte option was just a ridiculous amount of storage that nobody could ever possibly need. Can you even imagine that now? It's just wild how far we've come.
So here's the real kicker. The biggest benefit of having computers in trading isn't just about doing things faster, it's about liberation. The computer handles all the tedious, boring work of updating charts, and that frees up a trader's most precious resource, their time and their brain power to actually think, to strategize, and to analyze what's really going on.
Okay, so with all that freedom, you've got a critical choice to make. What software are you going to use? This next part is all about a core idea that really separates the serious traders from the hopeful gamblers. We're going to dig into the difference between a toolbox that actually empowers you and a so-called magic box that promises you the moon but usually just ends in disappointment.
So if you're serious, you need what the source calls a toolbox. This is software that puts you in the driver's seat. It's got to be able to draw charts on any time frame, weekly, daily, even intraday. It should come packed with all the popular indicators. And here's a big one. It should let you tweak them, or even build your own. And of course, things like stock scanners and the ability to backtest your ideas are pretty much non-negotiable for a pro setup.
Now this piece of advice right here, it's pure gold, especially if you're just starting out. It's so easy to get paralyzed trying to find the perfect software. But here's the key. It's a date, not a marriage. Just start with something simple, something inexpensive. Get your feet wet. Figure out what works for you and your style. Then, and only then, should you think about committing to a more powerful, long-term solution.
And this slide really lays out the 2 different worlds. On one side, you've got toolboxes. These are for traders who want to think for themselves, who want to build and refine their own system. On the other side, you have the black boxes. And honestly, they're for people who believe in Santa Claus. They're a magic show. They spit out buy and sell signals without ever telling you why. They try to replace human judgment, and that, my friends, is a fatal flaw. And this brings us to the cold, hard truth about these systems. Every single black box is basically guaranteed to fail. Why? Because markets aren't static puzzles. They're living, breathing things that change and evolve constantly. A rigid, automated system just can't keep up. Like the source says, the only person making real money from a black box is the person who's selling it to you.
All right, so we've tossed out the magic boxes. We've got our toolbox ready to go. Now it's time to look at the tools inside. This section is all about the core of technical analysis, the indicators. Think of these as special formulas that help us translate the raw chaos of price action into actual, understandable insights about what the crowd is thinking and doing.
Now, it's really important to get this. Not all indicators are the same. They pretty much fall into 3 main buckets. You've got your trend-following indicators like moving averages. These guys are your best friends when the market is making a clear move up or down. Then you have oscillators like RSI. These are designed to spot turning points, so they're most useful when the market is just chopping around sideways. And finally, you have a miscellaneous group that gives you a read on the overall psychology of the market.
The real key is knowing you need to pull tools from each of these different groups because no single group works well in all conditions.
And this is a classic trap for beginners. I mean, we've all been there, right? You're searching for that one silver bullet indicator that's just going to solve everything. But it doesn't exist. It's a myth. The market is way too complex, way too nuanced to be figured out with just one tool. A winning approach always involves combining several different indicators into a smart, coherent system.
So let's start with the absolute foundation of the trend-following group, the moving average. This is usually the very first indicator any new trader learns, and there's a good reason for that. It's a simple, powerful, and really intuitive way to see which way the market's inertia is flowing.
So what is a moving average really? Well, the source uses this brilliant analogy. It's like a composite photograph of the market. See, a single day's price is just one snapshot in time. But if you average the price over, say, 20 days, you get this beautiful, smoothed-out picture that shows you the real underlying trend, the average consensus of what everyone thinks something is worth. The slope of that line tells you everything you need to know about whether the crowd is getting more optimistic or more pessimistic.
But here's the catch. Not all moving averages are created equal. The original version, the simple moving average, or SMA, has a pretty big flaw. The analogy for it is perfect. It's like a guard dog that barks when a stranger arrives, which is great, but it also barks when a friend leaves. The SMA changes when a new price is added, sure, but it also changes when the oldest price from its calculation window gets dropped. That can create a false signal, a distortion that has nothing to do with what's happening in the market right now.
And that is exactly why modern traders have pretty much all switched to the exponential moving average, or EMA. The EMA is just smarter. It puts more mathematical weight on the most recent prices, which makes it react faster to what's happening today. And critically, it solves that drop-off problem. Old data just slowly fades away into irrelevance. This guard dog only barks when someone is actually walking up the driveway.
Okay, now this is where the rubber really meets the road. A super powerful technique is to put two EMAs on your chart, one that's fast and sensitive and one that's slower and smoother. The space between those two lines creates what's called the value zone. In a healthy uptrend, like you see right here, the price will often pull back into this zone. This gives you a chance to buy at a fair price before the trend continues up. See those circled points on the chart? Every single one was a dip into that value zone, and every single one was followed by a pretty nice move higher. Okay, so we've got a good handle on moving averages. Ready to level up? Let's build on that foundation with a more advanced indicator, the Moving Average Convergence Divergence, or MACD. We're also going to look at its most powerful signal, the divergence, which can flag huge market turning points with almost spooky accuracy.
Now, MACD sounds super complicated, right? But it's actually not that scary. It's just built from the same EMAs we were just talking about. You just take a 12-day EMA and a 26-day EMA and subtract the long one from the short one. That gives you the fast MACD line. Then you just take a 9-day EMA of that line, and that gives you your slow signal line. The push and pull between those two lines is what gives you your classic buy and sell signals. It's all about momentum.
Okay, now this chart is incredible. This shows you the real jaw-dropping power of what we're talking about. This is the historic market bottom back in 2009. Look closely. At point C, the stock market made a brand new, scary-looking lower low. Everyone was panicking. But look down at the MACD indicator. It made a higher low. That's a classic bullish divergence. It's the market whispering to you, saying, hey, even though the price is lower, the downward momentum is drying up. The sellers are exhausted. This was an insanely powerful signal that a monster rally was just around the corner.
And just so you can see it works both ways, let's flip the script. Here's the exact opposite situation at the market top in 2007. At point Z, the market was roaring, hitting a new, higher high. But the indicator was telling a very different, much darker story. It made a lower high than its previous peak. This is a bearish divergence. It's a sign that the price is rising on fumes. The buyers are losing steam. This was a massive warning sign for anyone who was paying attention that the party was about to end, right before one of the biggest crashes in recent history.
So, as we start to wrap this up, after seeing all these powerful tools, it might be tempting to think you've found the secret, right? Well, we have to come back to this essential reminder. Moving averages are awesome. MACD divergences are incredible, but not a single one of them is a complete trading system by itself. The market is just too complex, too dynamic. You have to combine these tools into a smart, well-thought-out plan.
So we've seen how computers completely change the game.
And we've explored some of the most powerful tools in the Technical Trader's Toolkit. Think of these indicators as a new language, one that helps you understand the market's patterns and decode the psychology of the crowd. But just knowing the vocabulary is only the first step. The real question, the one that every trader has to answer for themselves, is how are you going to put these words together to write your own story and build your own system?
You know how most traders are just glued to their price charts, right? Watching every single tick. But what if I told you that focusing only on price is like trying to watch a movie in just one dimension? In this explainer, we're going to unlock two more crucial dimensions that the pros use to see the full picture: volume and time. So let's get into it. I absolutely love this quote from Joseph Granville, who was a real pioneer in this stuff. It's honestly the perfect way to think about it. Price is the train, the choo-choo. But volume is the raw power. It's the steam that's actually driving the whole thing forward. If you don't understand the steam, you can't really know where that train is headed. All right, so here's our game plan. We'll start by looking beyond just price to really get a handle on volume. Then we're going to dive into the fascinating psychology behind it, learn how to read its most important signals, check out some powerful indicators that use volume, and then finally, we'll add that third dimension, time, to bring it all together. So let's start right there by challenging that flat, one-dimensional view. You'll hear people say, hey, you get paid on price, not on volume. And yeah, technically that's true, but it completely misses the point. Price tells you what's happening. Volume tells you why it's happening, and more importantly, with how much conviction. This is the default setting for so many people, just a simple chart showing price going up and down. It tells you part of the story, sure, but it's the part that literally everyone can see. The real edge in trading comes from seeing what other people miss, and this view, right here, is missing the market's true energy.
The pros, though, they know that to really understand the health and direction of a market, you have to add that second dimension, volume. It's just a measure of activity, the number of shares or contracts changing hands. But what it really is a direct window into the commitment and the actions of every other trader out there.
And this, for me, is where it gets really, really interesting. Volume isn't just some dry number on a chart. Every single one of those bars in the histogram, it tells a story of human emotion. It's about financial commitment, it's about conviction, and maybe most importantly, it's about pain. Think about it this way. Every single trade needs two people, right? A buyer who's betting the price is going to go up and a seller who's betting it's going to go down. The second they make that trade, they are both financially and emotionally locked in. Volume is simply the grand total of all that collective commitment.
And the moment that price moves, even one tick, one of them is winning and the other is losing. The winner feels amazing. The loser, they feel angry, depressed, you name it. So the higher the volume, the more people are tangled up in this emotional battle. A high volume move means a massive amount of pain is being felt by the side that got it wrong. And that pain, that's the fuel from major trends. This frog in boiling water analogy is just perfect for understanding how traders deal with that pain. A sudden, massive drop on huge volume, that's like tossing a frog straight into boiling water. It creates instant panic, forces losers to dump their positions, and often leads to a super sharp reversal. But a slow, grinding trend, that's like heating the water gradually. The losses build up so slowly that traders just kind of tolerate the pain until it's way too late. And that's what allows a trend to just keep on going. Okay, so we get the psychology. Now, let's get practical. How do we translate all that theory into actual signals that we can see on a chart and use? How do we actually read the story that volume is telling us day in and day out? Let's break down this chart of Sotheby's. Check out areas A and B. As the price is rallying, look at the volume bars below. They're also getting taller. That's a super healthy sign. It means more people are jumping in, conviction is growing. It confirms the uptrend. But now look at areas C and D. The price is trying to push higher, but the volume is just drying up. That is a massive red flag. The steam is running out of the engine. And finally, look at E. The price falls off a cliff and volume explodes. That confirms the power of this new downtrend. Fear and panic are officially in charge. So let's just boil all that down into a few simple pointers you can remember. High and rising volume, that confirms the trend. Shrinking volume, that's a warning sign that the trend is getting tired and could be ready to reverse.
A price breakout that happens on low volume, that shows a lack of commitment, and it's probably going to fail. And finally, a huge volume spike after a long decline, that often marks the bottom, where everyone who was gonna panic has finally thrown in the towel. Now, reading the raw volume bars is a powerful skill, for sure, but let's be honest, sometimes the signals can be a little messy. That's where indicators come into play. They help us smooth out all that data and really crystallize the messages that volume is trying to send us. Let's look at a few of the best ones. First up is on balance volume, or OBV. It is brilliantly simple. If the price closes higher for the day, you add all of that day's volume to a running total. If the price closes lower, you subtract all of it. OBV is an amazing leading indicator because it basically tracks the collective gut feeling of the market, which very often changes before the price itself catches on. And this chart of McDonald's just shows its power perfectly. Look at point E. The stock price is testing its recent lows. If you were only looking at price, you'd probably be pretty worried. But then you look down at the OBV indicator. It's actually near its recent highs. This is what we call a bullish divergence. It's screaming at you that even though the price is low, the smart money is flowing into the stock, not out of it. It's a huge clue that there's underlying strength and accumulation happening. Okay, next we have the accumulation/distribution line, or AD. This one is a little more sophisticated than OBV. It doesn't just care if the day was up or down, it looks at where the price closed within that day's range. A close near the high of the day gets a lot more positive credit than a close just barely in the green. It's a much finer tool for tracking buying and selling pressure. The psychology behind AD is just fantastic. It's built on this idea that amateurs tend to flood the market at the open, reacting emotionally to whatever news they just read. But the professionals, they're more active all day, and they really tend to dominate the close because their big trades are what determine that all-important settlement price. So the AD line is basically tracking this daily tug of war between the amateurs and the pros. And check out this incredible chart of Google. For months, the stock price was just grinding lower and lower. It would have scared most people off completely. But look at the AD line at the bottom. It was making a clear series of higher lows. It was telling you that while the amateurs were selling in fear, the pros were quietly buying, pushing the price off its lows every single day before the close. This was a massive tell, right before the stock exploded higher on an earnings report. The AD line showed that somebody, somewhere, knew something. All right, our last volume indicator is the force index. This one is so cool because it combines 3 essential pieces of information into a single oscillator. Number 1, direction. Did the price go up or down? Number 2, distance. How far did it move? And number 3, volume. How much power was actually behind that move? It literally measures the raw force of the bulls and the bears. And the great thing is we can smooth out the force index for different jobs. A really short-term 2-day force index, like you see on the left, is super sensitive. It's perfect for fine-tuning your entries and exits inside a trend that's already going. A longer-term 13-day version, like on the right, is much smoother. It's better for spotting major shifts in power between the bulls and bears, the really big trend changes. So we've covered price and we've covered volume, but to get that full 3D picture of the market, we need to add the final piece of the puzzle, time. Paying attention to time helps us understand where we are in a bigger market cycle, and it can stop us from doing silly things like buying at the very top or shorting at the very bottom. A truly brilliant way to visualize this is the indicator seasons model. We can think of an oscillator, like a MACD-Histogram, as moving through 4 seasons. It's based on 2 simple things. Is it above or below its center line? And is it rising or falling? When it's rising from below 0, that's spring, the best time to go long. When it's rising, but it's already above 0, that's summer, time to start thinking about selling. When it starts falling from above 0, that's fall, the best time to go short. And when it's falling below 0, that's winter, time to cover those shorts. And this chart of Vertex just shows the seasons playing out perfectly. You can see the indicator moving through winter, and then it turns up into spring. That's your ideal buy point. Then it climbs into summer, and as it turns down into autumn, that gives you the perfect sell signal. This whole framework just helps you get in sync with the market's natural rhythm. You're buying when things are cool but warming up, and selling when they're hot but starting to cool back down. So, by putting it all together, price, volume, and time, we go from looking at a flat, one-dimensional picture to having this rich, 3-dimensional understanding. You can see not just what the market is doing, but the force behind the move and the season that it's in. So the only question left is, Now that you can see the market in 3D, which hidden signals are you going to look for first?
Welcome to The Explainer. Today, we're going to decode the market's mood, those powerful and often invisible forces that can pull your entire portfolio up or down, no matter how great your individual stock picks are. All right, let's just dive right in with a question that I'm sure drives every single investor crazy at some point. You've done all your homework, you found a fantastic company, the fundamentals look amazing, but then you just have to sit there and watch as its stock price sinks right along with everything else. Why? Why does that happen? Well, the answer is actually pretty simple, and it's a big one. It's because the general market trend is like a massive ocean tide. And that tide is responsible for as much as half of the movement in any single stock. Your fantastic stock? It's really just a boat caught in that powerful tide. So look, if you want to be a smarter investor, you have to learn to read that tide. You have to learn to see the market's hidden current. It's all about looking past the individual trees so you can finally understand the health of the entire forest. I've got a great way for you to think about this, an analogy that's going to guide us through this entire explainer. Just think of the stock market as a huge army that's getting ready for a big battle. You know, the fate of any one soldier often has less to do with their own skill and more to do with the strategy and the morale of the entire army. So, in this army of ours, the big market indexes, like the S&P 500, they're the army itself, the main force. All the thousands of individual stocks, well, they're the soldiers in the ranks. And here's the most important part for us. The market leaders, the strongest stocks and the weakest stocks, they're the officers. You know, there's that old military saying, there are no bad soldiers, only bad officers. An army really is only as good as its leadership. So our first mission, our first piece of reconnaissance, is to figure out what those officers are doing. And the tool we use for this job is called the New High, New Low Index. It sounds a little technical, but the idea is dead simple. Every day, it just subtracts the number of stocks hitting new 52-week lows from the number hitting new 52-week highs. It's basically telling us right now, are more officers leading the charge uphill or are they deserting and running for the hills? Now, this is what makes it so powerful. It's a leading indicator. Check this out. The top part of the chart, that's the S&P 500, our army. And below it, in blue, that's the NHNL index, our officers. Just look at those red arrows. In every single case, you can see the officer's strength starts to crumble before the main army does. They start deserting before the army retreats. That's an early warning system. So we can actually look at this leadership data through two different lenses. The daily chart gives us a tactical view. It's great for tracking the day-to-day shifts in leadership and for short-term timing. But the weekly chart, that gives us the big strategic picture. And that's what helps us spot the major long-term trends and those really crucial turning points. And this right here, this is where that strategic weekly view becomes just incredibly powerful. When this indicator drops below -4,000, that signals total, unsustainable panic. But when it rallies back above that line, it triggers what's called a spike buy signal. The green arrows on this chart, which goes back more than a decade, show you just how unbelievably accurate this signal has been at nailing huge buying opportunities at major market bottoms. Okay, so we've got a handle on what the officers are up to. But what about the soldiers? Are they actually following them into battle? A general with a brilliant plan is pretty useless if the troops refuse to charge. This brings us to our next critical concept, market breadth. We need to measure the participation of the rank-and-file stocks.
One of the best ways to check on troop morale is to see how many of them are trading above their 50-day moving average. Now, a moving average, it's really just the average price of a stock over the last 50 days. It kind of represents the general consensus of what it's worth. So if a stock is trading above that average, it means the consensus is pretty positive. This indicator tells us what percentage of the army is feeling optimistic.
This indicator gets really interesting at the extremes. When you see it dip below 25%, that means less than a quarter of all stocks are feeling optimistic. That's widespread fear. That's panic. And as you can see with the green arrows, when it turns up from that level, it often marks a fantastic buying opportunity. On the flip side, when it gets above 75%, the market can be running hot on pure greed. A turn down from that level, like you see with the red arrows, can be a huge warning sign that a top is near.
Another classic tool for this is the advance/decline line. You can think of it as a simple daily head count. How many of our soldier stocks advanced today versus how many retreated? We keep it running tally, and this line shows us just how many troops are participating in the market's trend. Now, what we're really looking for here is confirmation. We want to see the troops and the market marching in lockstep. But take a look at Area B on this chart. The S&P 500 is pushing up to a brand new high, but the advanced decline line is actually making a lower high. This is the classic warning sign, a bearish divergence. It's telling us that fewer and fewer soldiers are actually participating in this latest push. The rally is running out of steam.
All right, we've checked in with the officers, we've surveyed the troops. Now for our final piece of intel. We need to listen to the chatter on the battlefield. We need to get a read on the market's mood. And this brings us to market sentiment and the fine art of contrary thinking.
And this all comes down to the core idea of contrary thinking. You see, by the time an idea becomes the obvious move for everyone, whether that's being super optimistic or super pessimistic, there often aren't enough new people left to keep pushing the trend in that direction. The move is probably on its last legs.
So what does that extreme bullishness, that top of the market, actually look like in the wild? Well, you'll see a bull on the cover of a big magazine. It's when you turn on the TV and see 3 different brokerage firms all running ads for the exact same hot investment. It's when your email's spam folder is suddenly overflowing with get-rich-quick penny stock schemes. These are all signs that optimism has gone way too far and the trend is getting old.
We can also measure this stuff with hard data, and a fantastic metric for that is something called short interest. Basically, this is the number of shares that bearish traders, the pessimists, have borrowed and sold because they're betting the stock's price is going to fall. Now, when this number gets really high, it tells us that the bearish trade has become dangerously overcrowded.
And this table is a perfect example of what I'm talking about. On one hand, you have a company like Apple. Pretty normal short interest, nothing crazy. But then, look at Green Mountain Coffee. Whoa! On this day, almost 26% of all its available shares were sold short. It would have taken over 15 days of normal trading just for those bears to buy back their shares. That is a massive pile of potential buying pressure just waiting to explode. It's pure rocket fuel for a rally if good news hits and those short sellers get squeezed.
Okay, so we've got all the pieces, right? The leaders, the troops, and the crowd's mood. Now let's put it all together and build a simple dashboard you can use to really understand the market's health and start making much better decisions. But before we do, I have to give you the single most important rule of all this. No single indicator is a magic bullet, ever. They don't work 100% of the time. The real power, the real edge comes from confirmation, when you have multiple, different indicators that all start telling you the exact same story.
So it really just boils down to this simple 3-step process. Step 1, are the officers leading the charge? Check the new high, new low index. Step 2, are the soldiers actually following them? Check market breadth with something like the advanced/decline line. And step 3, what's the mood on the battlefield? Gauge sentiment to see if the crowd is way too scared or way too greedy.
By following this framework, you stop just reacting to the chaotic day-to-day movements of individual stocks, and you start actually understanding the bigger forces that are pushing them around. You can finally see the whole forest, not just a few trees. So the only real question left is, what are you going to look for first?
Welcome. You know, when you look at the financial markets, it can feel like pure chaos, right? A total storm of flashing numbers and crazy price swings. But what if I told you that the best traders in the world, they don't just survive this chaos, they actually thrive in it. And they do it by imposing order. They use a blueprint, a system. Okay, let's dive right in and understand exactly how they do it.
So in this explainer, we're going to break down the whole idea of trading systems. We'll kick things off with why you even need a plan, then explore the 2 main philosophies of trading, and cover the 3 rules that are absolutely non-negotiable for every single trade. Then we'll get into the good stuff, 2 powerful examples, the triple screen and the impulse system. And finally, we'll wrap it all up with what is maybe the most important piece of the puzzle, discipline.
All right, let's tackle the main problem head on. When you're in the heat of the moment with your real money on the line, emotions like greed and fear, they just take over. A system, well, that's your anchor. It's what keeps you rational when everything else is turbulent. It's the plan you make when you're calm to protect you from yourself when you're not. The classic debate, isn't it? Is trading some kind of creative, intuitive art, or is it a hardcore science, all based on data and rigid rules? The truth, as we're about to see, is that the best trading actually lives somewhere in the middle, and a good system is what helps you find that sweet spot. I love this analogy. Think about a surgeon. A surgeon doesn't just walk into an operating room and start winging it, right? Of course not. They follow a very specific routine, a checklist. Now, this doesn't make them less skillful. It actually frees up their mental bandwidth to handle any unexpected problems. A trading system does the exact same thing for a trader. It puts the routine stuff on autopilot so you can focus on the big picture. So, you're convinced you need a system. Great! Now you come to a fork in the road, and the path you take often just comes down to your personality. Are you going to follow a rigid, rules-based approach, or one that leaves a little more room for your own judgment? Let's break down these two main styles. On one side, you have mechanical trading. You build a system, you backtest it, and then you basically let it run on its own. The huge advantage here is it strips out a lot of the emotional drama. But the downside, well, markets change, and a rigid system can fall out of sync and just start losing money. Then on the other side, you've got discretionary trading, which is much more adaptable. You have rules, sure, but you also have the freedom to weigh different things and pounce on new opportunities. The huge risk, of course, is that your judgment can completely crumble when you're under pressure. And this is such a key point. For the pros, this isn't really an either-or decision. The absolute best traders, they blend the two. A mechanical trader might use their discretion to decide which of their automated systems gets more capital. And a discretionary trader, like me, will use super strict mechanical rules to stop themselves from making a catastrophic emotional mistake. Now, it doesn't matter if you lean mechanical or discretionary. Some things are just non-negotiable. Before you risk even $1, there are 3 questions you absolutely, positively must have an answer to. So let's see how these demands build the foundation of a real trade plan.
Take a look at this. This is a real trade plan from spiketrade.com. See those 3 highlighted sections? Box A is the trade setup, your entry, your target, your stop price, all clearly defined. Box B is risk. Your maximum dollar risk is calculated, and that tells you your position size. And Box C is the strategy. The trade has to fit a pattern you've already defined. These aren't just good ideas, they are demands. So here's the bottom line. 1. Define all your numbers before you get in. How much will you pay? Where are you taking profits? And where are you cutting your losses? 2. Define your risk in dollars. This is huge. It takes all the guesswork out of position sizing. And 3. The trade has to have a reason that goes beyond a gut feeling. It looks good is not a strategy. If you want to be a serious trader, the days of chasing stocks like a puppy chases cars are over. Okay, let's get into the nitty-gritty. We've got the foundation down, so now we can really explore one of the most solid, time-tested systems out there, the triple screen system, which I actually first developed way back in the 1980s. This quote just nails the whole philosophy of triple screen. The market, it's just like the ocean. You've got multiple trends all happening at once. The long-term trend, that's the tide. The medium term, that's the wave. And the short-term stuff, that's just noise, the ripples. The entire system is built to make sure you're always swimming with that powerful tide. So here's how it works. We use 3 screens, or you can think of them as filters. The first screen looks at a long-term chart, like a weekly, to figure out the market's main direction. That's the tide. This is our strategic decision. Are we feeling bullish or bearish? The second screen uses a medium-term chart, like a daily, to find pullbacks against that tide. Those are the waves. And finally, the third screen is all about tactics, pinpointing the perfect entry point. Let's look at the first screen in action here on a weekly chart of gold. We're using an indicator called the MACD-Histogram. When its slope turns up, like you see at arrows A, C, and E, the system says we can only look for chances to buy. When the slope turns down, like at B and D, we can only look to sell short. Just this one step immediately wipes out 50% of bad trades, the ones that try to fight the dominant long-term trend. Okay, now we move to screen number 2, the daily chart. Let's say our weekly chart tells us the tide is rising. So, what do? We look for daily dips, waves going against that tide. On this chart, we're using an oscillator called the force index. During that weekly uptrend, which is marked by the green bar, every single time the daily force index dips below 0, that's a signal for a potential buying opportunity. See, we're looking to buy weakness, but only within a bigger picture of strength. And now the third and final screen. This is our entry technique. Instead of chasing a breakout and paying a premium for it, this method is all about fishing for a bargain. On this chart, you can see that during the uptrend, prices sometimes dip below that fast-moving average. so we can measure the average size of those dips, like A, B, C, and D, and use that info to place our buy order below the current market price, waiting for a little pullback to get us in at a fantastic price. This table really sums up the entire logic. It's a simple decision tree. If the weekly trend is up and the daily trend is down, that's our cue to go long. But notice what's missing here. If both trends are up, or if both are down, the system tells us to just sit on our hands. And why is that? Because we're not chasing momentum. We are patiently looking for that high probability entry point on a pullback. It's a clear, logical filter.
Now, not all systems are made to spit out buy and sell signals. Some are actually designed to be a filter, a sort of sensor that tells you what not to do. So let's look at another really powerful tool, the impulse system. The idea behind the impulse system is actually beautifully simple. It measures two things. First, market inertia, which we can track with a moving average. Is the market generally drifting up or is it drifting down? And second, it measures power or momentum using the MACD-Histogram. Is the trend speeding up or is it slowing down right now? The system's logic is super visual. When both inertia, tracked by an exponential moving average, or EMA, and power from the MACD are rising, the bar on the chart gets colored green. That means the bulls are in complete control. If both are falling, the bar is red, bears are in charge. And if they disagree, the bar is blue, which tells us the market is kind of neutral or conflicted. So at first, I thought this could be a fully automatic system. Buy on green, sell on red. Simple, right? Well, it just got chopped to pieces in trading ranges. The big breakthrough came when I realized its true purpose. And that's when it hit me. The impulse system is a censorship system. Its real power is in telling you when conditions are absolutely unsafe for a certain move. Check out this chart. The rule is dead simple. If a bar is red, you are forbidden from buying. Period. End of story. If a bar is green, you are forbidden from shorting. The absolute best time to look for a chance to buy is right after those red bars disappear, which you can see marked by the green arrows. This system keeps you out of so much trouble when a downtrend is in full swing, and it helps you spot the exact moment that pressure has finally let up. Okay, as we start to wrap up, let's bring it all back to the core idea. Whether you use triple screen, the impulse system, or something you design yourself, its true purpose goes way beyond just finding trades. Your system is your pre-committed plan of action, and it's designed to keep you rational when the market is doing everything it can to make you emotional. At the end of the day, no system can perfectly predict the future. It's just not possible. The real goal of a trading system is to manage your behavior in the face of that uncertain future. It's what provides the structure and the discipline you absolutely need for long-term survival and success. So the final question I'll leave you with is this. If you had to write down just one rule for your own system, the most important one, the one to protect you from yourself, what would it be? So you want to trade the markets. You know, we're going to take a tour today, but probably not the one you're expecting. We're not here to pick stocks or try and predict what the market's going to do next. Nope. Instead, we are heading straight to the showroom to check out all the different vehicles you can use to navigate these crazy markets. You got stocks, you got futures. Each one has a totally different engine, its own set of risks, its own rules of the road. And trust me, choosing the right one for you, that is the most critical first step you can take. So, let's get you the keys. Okay, so here's our game plan. First, we're going to cover the two things every single trader needs to think about before they even think about picking a vehicle. Then we'll pop the hood on stocks, you know, the one everybody's heard of. After that, we dive into the murky world of ETFs and CFDs, where things are definitely not always what they seem. Then it's on to the high-stakes world of options, and then into the real pro arenas, futures and Forex. And finally, we'll pull it all back together to help you figure out your own path. All right, first up. Look, before you even take a car for a test drive, you have to understand the terrain, right? Well, it's the same with trading. All those charts might look like similar roads on a screen, but believe me, the mechanics humming away underneath are wildly different from each other. This right here is the single most important question you can ask yourself at the start of your journey. And the answer has nothing to do with what's popular or what some guy on the internet says will get you the fastest returns. No, it all comes down to two crucial factors that really define whether you can even trade an asset effectively. And here they are, liquidity and volatility.
Just think of liquidity as your safety net. When a market has high liquidity, meaning tons and tons of trading volume every day, you can slip in and out of your positions without anyone really noticing. But in an illiquid market, oh man, trying to sell a big position it's like trying to force a fat cow through a narrow gate. You are going to leave chunks of your profits stuck on the fence posts. Now, volatility, on the other hand, that's where the action is. Those are the price swings that give you a chance to make money. So the real trick is finding a vehicle with enough volatility to be interesting, but enough liquidity to keep you safe.
So let's start with the classic sedan of the trading world, stocks. Most people feel like they know stocks, but there's a really fundamental concept here that so many traders just forget. A stock isn't just a ticker symbol bouncing around on a screen. And this is what's so essential to get. When you buy a stock, you are buying a tiny, fractional piece of a real, living, breathing business. The price is driven by the crowd's collective guess about the future of that business. If the crowd is feeling optimistic, they bid the price up. If they get pessimistic, they start selling, and the price drops. You're not just trading a symbol, you're trading what everyone thinks that company's future is going to look like. And that brings us to the whole psychological game, which Warren Buffett just perfectly captured with his famous business partner, Mr. Market. Buffett said to imagine the market as your business partner, and every day this guy shows up. Some days he's just euphoric, totally manic, and he offers you an insane price for your shares. That's your cue to sell. But on other days he is deeply depressed, and he offers to sell you his shares for a ridiculously low price, and that is your chance to buy. The whole challenge for a trader is just to stay sane while your partner is swinging from one emotional extreme to the next. Okay, let's move on to the next part of the showroom. And for this one, you really need to have your guard up. Exchange-traded funds, ETFs, and these things called contracts for difference, CFDs, they're often sold as these super easy, accessible ways to trade. But there's a dark side to them that the industry really doesn't want you to know about. So, on the surface, the idea seems great. Let's say you want to trade gold or the S&P 500 or even something abstract like the volatility index, but you don't want to deal with the whole futures market. So you just buy an ETF that's designed to track that thing. Sounds perfect, right? A simple, elegant solution. The problem, as you're about to see, is in how they actually work. Okay, just look at the slide. This shows you everything you need to know. On the left, you've got the volatility index, the VIX. Over 2 years, it bounces around, it goes up, it goes down, but it basically ends up where it started. Now, look at the chart on the right. That's VXX, the popular ETF that is supposed to track the VIX. It has done nothing but go straight down, losing over 90% of its value. That is not tracking. That's a slow-motion train wreck. It's called tracking error, and it can absolutely destroy your account. And in case you think that was a one-off, check this out. This isn't some isolated problem. On the left, you've got the price of natural gas. After this huge decline, it finally found the bottom in 2012 and started to rally. Now look at its popular ETF, UNG, on the right. It just completely missed the memo. It blew right past the bottom and kept sliding towards zero. So many traders lost fortunes trying to buy the dip in that ETF, never realizing the vehicle itself was fundamentally broken. So when it comes to these kinds of ETFs, the rule is simple. Buyer, you better beware. Now, if you thought ETFs could have some hidden flaws, CFDs, well, they take the potential for conflicts of interest to a whole other level. As this trader points out, with CFDs, you're not just trying to beat the market anymore. You're also trying to beat the house, the casino that literally creates the game and sets all the rules. Let's be really clear here. A CFD is not a security like a stock. It's a direct bet between you and your broker on where a price is going to go. This means your broker is your direct opponent. When you want to trade, the money comes straight out of their pocket. And when you lose, it goes straight into theirs. This is a massive, massive conflict of interest. The risk here is so obvious that CFDs are totally banned for regular traders in the United States. Kind of like how the FDA kept that dangerous drug thalidomide out of the country back in the 60s to protect people. All right, moving on. Let's talk about our next vehicle. Options. This is a truly fascinating world, and it's built entirely on one thing, trying to predict the future. And as one old-school market maker put it, it's really a business that's built on hope. See, in the options market, there are two very distinct sides to every single trade. On one side, you have the option buyers. These are mostly amateurs, gamblers, people drawn in by the dream of turning a small bet into a huge profit. They are quite literally buying hope, the hope that a stock makes a massive move in their favor. And as a group, they consistently lose money. On the other side, you've got the option writers, the sellers. These are the pros, the big, well-capitalized players. They act just like the casino. They price and sell that hope to the public. And just like the casino, as a group, they consistently make money over time.
So why is buying options so incredibly difficult? Because it's a triple threat challenge. To make money, it's not enough to be right about the direction. You have to be right about which stock is going to move, you have to be right about how far it's going to move, and you have to be right about how fast it's going to get there. It's like trying to toss a ball through 3 moving rings at a carnival game. If you miss even one of them, you lose your whole bet. Even if the stock does what you want, but it does it too slowly, time decay will just eat away at your option's value until it's completely worthless.
And this quote from a floor trader, man, it just says it all, doesn't it? The professionals, they're not trying to guess the future. They are in the business of calculating probabilities. They walk in every morning, they see what the public is hoping for, and then they figure out a price for that hope, and they sell it to them. You just have to decide which side of that business you want to be on. Okay, buckle up. We are now entering the high-stakes arenas, the domain of the pros, futures, and Forex. The one thing that defines these markets is leverage, the ability to control a gigantic position with a tiny amount of capital. And this is a serious double-edged sword that can make you a fortune or wipe out your account with blinding speed. Let's use a quick example just so you can see how this works. Let's imagine gold is trading at $1,500 an ounce. If you wanted to go out and buy a standard 100-ounce gold bar, you'd have to pony up $150,000 in cash. And this is where the incredible power and the incredible danger of futures becomes so clear. Instead of paying the full 150 grand, you can trade a gold futures contract. And to control that exact same amount of gold, you only need to put up about $7,500 in margin. Think about that. If gold rallies just 5%, your profit is $7,500. That's a 100% return on your capital. But, and this is a huge but, that leverage cuts both ways. If gold dips by 5%, you lose your entire margin. You're wiped out. That's why futures demand absolute iron discipline. Now, in the world of Forex or currency trading, there is another trap waiting for retail traders. Just like we saw with CFDs, most of the retail Forex brokers out there are not your agents. They are your opponents. They often bucket your order, which is a fancy way of saying they never even send it to the real market. They just take the other side of your bet. It's a game where the house holds all the cards. The pros will tell you, if you want to trade currencies, use the regulated currency futures market. That way your broker is actually working for you, not against you.
All right, we've toured the entire showroom. We've looked under the hood of all the major trading vehicles, we've seen the reliable family sedan, and we've seen these super high-performance race cars. So the big question is, how do you take all of this and choose the right vehicle for your journey?
So let's wrap this all up with a handy little guide. Stocks, they're best for beginners, long-term investors. But you got to watch out for those emotional swings from Mr. Market. Broad index ETFs, like for the S&P 500, can be good for diversification. But most of the others, they just suffer from terrible tracking. Remember, buyer beware. Options are a pro's game, best for those who get how to sell hope, not just buy it. Futures, they offer incredible opportunity for disciplined traders, but that extreme leverage is always a risk. And for Forex, please, stick to the regulated futures markets to avoid getting into a fight with your own broker. You know, at the end of the day, the market offers this incredible endless array of vehicles and tools. You can choose from thousands of different instruments to pull off any strategy you can dream up. But the most important factor for success, it's not the vehicle you choose, it's the driver. It's your own discipline, your risk management, your psychology. So the final question really isn't about which vehicle is best. It's about whether you're ready to handle the road ahead. Thanks for watching.
All right, so today we are tackling what is, without a doubt, the single most important topic in trading. This is the thing that really separates the pros from the amateurs: risk management. Look, the core challenge of trading isn't about being right every single time. I mean, nobody is. It's about having a system in place that makes sure you can survive to trade another day, especially on those days when you're just plain wrong.
And you know, there's this quote from Mike Tyson that just nails the reality of the market. You can have the most brilliant trading system. You can have the most beautiful charts, but the market, well, it doesn't care one bit about your plan. At some point, it is going to punch you in the mouth with a move you did not see coming. The real question, the one that defines your career, is what do you do after you get hit?
And that right there is where most people fail. It's not actually the punch that knocks them out, it's the paralysis that follows. The amateur trader sees a position go against them and they just freeze. They hope, they might even pray for it to turn around. Some even double down, adding more money to a losing trade. And this kind of wishful thinking, it almost always leads to a devastating, account-crippling loss.
So why?
Why do smart, rational people make such totally irrational decisions with their money? Well, it turns out our brains are often hardwired to do the absolute wrong thing at the worst possible time in the market. Let's dig into the psychology of what's really going on up there.
Okay, so look at this. It's like two different worlds, right? The amateur is on this wild emotional roller coaster. They're counting their profits before they're even real, dreaming about the car or the vacation they're going to buy. For them, the market is basically a casino, a form of expensive entertainment. But the professional, totally different. They are detached. They're focused only on executing their plan. They know that any single trade has a huge element of randomness, and that real successful trading is actually, well, kind of boring.
So why is it so ridiculously hard to just cut a losing trade? Well, a big reason is this powerful little quirk in our brains called the endowment effect. The moment we buy a stock, it's not just a ticker symbol anymore. It becomes ours. It feels like an extension of us, of our smart decision. So selling it for a loss, that feels like admitting we failed personally, which makes it incredibly hard to let go of. Kind of like that old jacket in your closet you know you're never going to wear again, but you just can't bring yourself to throw out. Okay, let me show you how this actually works in your own brain. Look at test 1 on the left. Imagine I offer you a choice, a sure $700 or a 75% chance to win $1,000. What do? Well, 4 out of 5 people take the sure thing. We're risk-averse when it comes to profits. But now, look at test 2. Here you have a sure loss of $700 or a 75% chance of losing $1,000. Suddenly, 3 out of 4 people become gamblers. They will risk a bigger loss just to avoid the certainty of a smaller one. This is exactly what a trader does when they hold on to a losing position, hoping it'll come back. And this right here is the genius of Nobel laureate Daniel Kahneman's work. The pain of a loss is just psychologically so much more powerful than the pleasure of an equal gain. This loss aversion is what drives us to take those desperate gambles. It's the little voice in your head that turns what should have been a small, manageable failure into an absolute disaster for your trading account.
So if our natural instincts are basically wired to make us fail at trading, how in the world do we fix it? Well, the answer is you have to stop thinking like a gambler and start thinking like a professional. It's a fundamental mindset shift, moving away from trying to predict the future and focusing entirely on your process.
Let's really break down that shift. The amateur is completely obsessed with the outcome of whatever trade they're in right now. They're operating on hope, hunches, and emotion. The professional, they know the future is unknowable. They couldn't care less about one single trade. They focus on executing a simple, solid system that they know has a positive edge over hundreds of trades. And they never let one trade threaten their entire account. They only take what's called a businessman's risk, a small, calculated risk that won't kill them if it goes wrong.
Here's the thing. Your goal shouldn't even be to make money on any one trade. Your real goal is to become the best trader you can possibly be. That means handling every single trade with the focus and the precision of a surgeon. No sloppiness, no shortcuts. When you just concentrate on trading correctly, guess what? The money follows as a natural byproduct of your professionalism.
Okay, so this professional mindset is the foundation. But you can't live in a foundation. You need walls, a roof, you need concrete, non-negotiable rules. So let's get practical and talk about the tools that bring this mindset to life, starting with the absolute first and most important rule of survival.
Markets can kill your account in one swift, violent move. We call this the shark bite. It's that one trade where you broke your rules, you let a loss run wild, and it just took a massive chunk out of your capital. A loss like that doesn't just hurt your account, it completely shatters your confidence, and it can make it almost impossible to trade effectively for a long, long time.
So, we need some shark repellent, right? Well, here it is, the 2% rule. This is completely non-negotiable. It simply says you are never, ever, under any circumstances, allowed to risk more than 2% of your total trading capital on any single trade. If you follow this one rule religiously, it makes a catastrophic shark bite loss mathematically impossible.
So how do you actually use this rule? It's a simple 3-step formula that I like to call the iron triangle of risk control. This thing removes all the guesswork, all the emotion from one of the most critical decisions you make as a trader: how many shares or contracts you should be trading.
All right, let's break this down. It's actually super simple. The triangle has 3 parts. Part A is your maximum dollar risk. That's just 2% of your account, the number we just talked about. Part B is your risk per share, which is the distance between where you get in and where your protective stop loss is. You just divide A by B and it spits out C, the absolute maximum number of shares you are allowed to trade. That's it. It's that simple.
Okay, let's make this real. On the screen, you've got two charts. Silver on the left, wheat on the right. Now, both of them are showing really similar, really promising buy signals. They both look great, technically. An amateur might look at these and think, hey, these are basically the same trade. But are they? Not even close.
Let's run the numbers. Follow along with me here. Let's say we have a $50,000 account. Our 2% max risk is $1,000. Now look at the silver trade. The risk on a single contract, just the distance from our entry to our stop, is over $4,000. That is 4 times our maximum allowed risk. This trade is an absolute no-go. It's a shark waiting in the water. But now look at wheat. The risk per contract is only $500. That's well within our $1,000 limit. We can take this trade. The charts looked the same, but money management tells us one is a reckless gamble and the other is a calculated risk.
So the 2% rule keeps the sharks away. Awesome. But, there's another predator lurking in the market that can be just as deadly, but in a totally different way. And for that, we need a second rule.
This isn't one big violent bite. This is death by 1,000 cuts. It's not one big loss, but a string of small, manageable losses that just keep happening one after another after another. This is the dreaded losing streak, and it can bleed an account dry, stripping it down to the bone just like a pack of piranhas. It happens to every single trader, and you have to have a defense against it. And that's where this rule comes in, the 6% rule. Think of this like an automatic circuit breaker, an emergency brake for your trading. It says that if at any point during a month, the sum of your realized losses plus the potential risk on your currently open trades hits 6% of your starting capital, you're done. You stop opening new trades for the rest of the month. It forces you to get out of the water before the piranhas can finish the job. It preserves your capital and maybe more importantly, your mental sanity for the next month.
Let's walk through an example so you can see exactly how this works in practice. Okay, our trader starts with $50,000. His 6% monthly limit is $3,000. He opens trade A, B, and C, each with $1,000 risk. His total risk is now $3,000. He's at his limit. He is not allowed to open trade D. But then trade A becomes a winner, and he moves his stop to his entry price. The risk on that trade is now 0. His total risk drops to $2,000, so he now has room to open trade D. A bit later, trade B hits its stop, and he takes a $1,000 loss. Now his total risk is that $1,000 loss plus the $2,000 he still has at risk on open trades. He's right back at the $3,000 limit. He cannot open trade E. You see? It's a dynamic cap that protects him when he's cold and lets him press his advantage when he's hot.
Okay, so we have the mindset. We have two powerful, concrete rules. But who's going to make you follow them? This brings us to the final and honestly the most critical piece of this whole puzzle. Think about this for a second. If I offered you $10 to walk across a wooden plank sitting on the floor, you'd do it in a heartbeat, right? The risk is basically 0. But what if I took that exact same plank and put it between 2 skyscrapers and offered you $1,000 to walk across? Nobody would do it. And this just illustrates the point perfectly. The task, walking the plank, is identical. What changed? The risk. And increasing your risk doesn't just increase your potential reward, it fundamentally messes with your ability to perform even the simplest tasks.
On a professional trading floor, there's a manager, and their only job really is to enforce discipline. They're the ones who set the 2% and 6% rules, and if a trader breaks them, they're gone, fired. The funny thing is, when many of those traders go out on their own, they fail, because that external discipline is suddenly gone. As a private trader, you don't have a manager. You have to be your own tough, disciplined boss. You have to be the one to enforce the rules no matter how much you want to break them. So the crucial question you have to ask yourself is this: are you ready to take on the most important job in trading? Are you ready to be your own risk manager?
Hey everyone, and welcome. Today we're diving into something that can completely change your trading career, moving from that chaotic, almost gut-feeling style of trading to a disciplined professional process. You know what I'm talking about, right? If you've ever felt like your decisions were based more on hope than a real plan, then you are in exactly the right place. Let's build that plan. So let's just get right to it and ask the big question, the one that probably keeps a lot of traders up at night. Is what we're doing here really any different than just pulling a lever on a slot machine in Vegas? It's a real fear, and honestly, for a lot of people, it's dangerously close to the truth. That line between a calculated risk and a pure gamble, well, it's a lot thinner than you might think. And this quote just hits the nail on the head, doesn't it? The single biggest thing that separates a professional from a gambler is having a plan for when you're wrong. A trade without a stop loss isn't some clever strategy. It's just a bet on blind luck. And hey, at least in a casino, the drinks are free. And this is really what's at stake. Our source material calls it the shark bite. And that's such a perfect image. It's that one trade that you just let run against you, the one you keep hoping and praying will turn around, and then it doesn't. And it takes a massive chunk out of your account. It's not the little paper cuts that end most trading careers. It's this single, devastating bite. So how do we avoid the sharks? Well, we build a better boat. And this explainer right here, this is your blueprint. We're going to break it down into 3 crucial parts. First, we'll learn how to plan our profits like a pro. Second, and this is huge, we'll master how to plan our escape to protect our capital. And finally, we'll talk about the discipline it takes to only take the absolute best trades. All right, let's jump into our first principle, planning your profit. Now, I know that might sound a little weird. I mean, don't we want unlimited gains? But as we're about to see, professionals know that the most powerful word in trading isn't more, it's enough. And what's so interesting here is the contrast in mindset. You've got the gambler, right? They're on this emotional roller coaster, feeling like a genius when the stock goes up, then panicking when it dips, making every decision based on how they feel. But the trader, they have a predefined target. They know exactly what enough looks like before they even get into the trade. Their decision to get out is systematic. It's logical. It's not emotional. This brings us to a rule that is absolutely non-negotiable for professionals. Your potential reward has to be at least twice as big as your risk. It's that simple. If you're risking $1, you need a realistic shot at making at least 2. If the math isn't there, you just don't take the trade. It's a filter that forces you to only focus on opportunities that have a real mathematical edge in your favor. I absolutely love this analogy. So many of us, especially when we start out, are chasing that one massive win, right? That elephant that's going to make our entire year. But the pros, they know that stacking up consistent, smaller, well-planned wins, the rabbits, that's what actually builds an account over time. It's all about reliability, not hitting the lottery. And this chart is a perfect illustration of that rabbit hunting idea. We're looking at a short trade in VeriSign, ticker VRSN. The plan was to enter near the top of that trading channel you see, based on a clear sell signal. But now, look at the exit. The trader didn't get greedy and wait for it to hit the absolute bottom. No, they took their profit in what's called the value zone, that area between the moving averages. That was their pre-calculated target for enough. A perfect rabbit hunt, locking in a solid, repeatable profit instead of gambling for more. Okay, so we know how to plan for a win, but now we've got to talk about what's probably the most important part of long-term survival in this game. Planning your escape. This is all about the art of the stop loss. This is your non-negotiable defense against those shark bites. And this is just the perfect way to think about stop losses. I mean, have you ever been stopped out of a trade right at the low, only to watch it reverse and soar without you? Yes, it is incredibly frustrating. They can be a real pain, but trying to trade without them is a guaranteed road to ruin. They are the necessary evil that keeps you in the game to trade another day. So how do we use them intelligently? Well, here are 4 brilliant rules. First, you've got to place your stop outside the random day-to-day chop, the market noise. Second, try to avoid the super obvious spots, like right below a major low, where you know a huge crowd of other stops are going to be clustered. Third, once a trade is working nicely for you, move your stop up to at least break even. Protect those profits. And finally, the golden rule. You never, ever, ever move your stop farther away to give a losing trade more room. That's not trading, that's just hoping. So here's a fantastic little pro tip for avoiding those obvious levels. It's called a nick stop, and the logic is pure genius. You see, most amateur traders put their stop just below the most recent single lowest low. The big market players know this, and they'll often push the price down just enough to trigger that cluster of stops before reversing. So, by placing your stop just below the second lowest low, you give your trade that little bit of extra breathing room to survive the stop hunt. Let's see exactly how this works on these 2 charts. Look at the Coca-Cola chart on the left. The absolute low is at bar C. That's where the crowd puts their stops. But the smarter nick stop goes just below bar B, the second lowest low. Now look at the short trade on the right in ISRG. The highest peak is C, but the next stop is placed just above the second highest peak at B. It's a small adjustment, but it's a powerful way to stay out of the herd's way. And finally, on stops, there's one more layer of protection. Think of this as your life jacket. You always need to have a catastrophic stop, which is a hard order that's actually in the system. You put on a life jacket hoping you'll never, ever need it. But if something totally unexpected happens, some crazy news event, it's the one thing that will absolutely save you from that account-ending shark bite. Okay, so we've planned our profit and we've planned our escape. Now it's time for the final piece that ties this whole professional approach together, planning for quality. This is what elevates you from just surviving in the markets to actually thriving. It's all about being incredibly selective. You know, one of the biggest advantages you and I have as private traders is the freedom to do absolutely nothing. We don't have to trade. We can wait for that perfect pitch. And that incredible power is unlocked by asking yourself one simple, game-changing question right before you click that buy or sell button. And that's it. That's the question. Is this an A trade? Just asking this forces you to pause, to stop, and to really evaluate the setup. It completely shifts your mindset from, I need to find a trade, to, I will wait for a trade that perfectly fits my proven strategy. It's the difference between hunting for scraps and waiting patiently for a feast.
So what really qualifies as an A trade? Well, it's a setup that looks like a perfect textbook example from your own personal trading plan. It's a pattern you know inside and out, one you've tested and that you know has a positive expectancy. A really good concrete metric for this is a trade where you capture at least 30% of that day's trading range or channel. It's not just about getting a win, it's about getting a high-quality, repeatable win. And to really get objective about this, you can actually grade your trades with math. For instance, to grade your entry, you could measure how close you got to buying at the absolute low of the day as a percentage. You'd do the same for your exit relative to the high. This helps you compare how much you actually made versus how much was available. And it turns your trade review from an emotional process into a really objective analysis. Okay, check this out. This is a beautiful textbook example of an A trade in the stock Schlumberger. So this trader's main go-to strategy was something called a false breakout with a bullish divergence. Now look at the chart. You see how the stock's price made a new low at point C? But now look down at the MACD indicator. At the exact same time, the indicator made a higher low. That's the bullish divergence. That's the A+ high probability signal. The entry was crystal clear, and the trade captured a massive part of that powerful move up that followed. This is the kind of perfect setup you should be patiently waiting for.
So let's bring it all home. This right here is your blueprint for success. Number 1, plan your profit. Know what enough is, and always, always demand at least a 2-to-1 reward for your risk. Number 2, plan your escape. Use smart stops to survive the losing trades, because they will happen, and to avoid that catastrophic shark bite. And number 3, plan for quality. Know exactly what your perfect A trade looks like, and have the discipline to sit on your hands and wait for it.
And we're going to end with this powerful challenge. It really says it all. It's not just about finding any old trade, it's about being able to clearly define what an ideal opportunity looks like for you, based on your own tested strategy. So the question I want to leave you with is this. Can you, right now, describe your A trade with absolute clarity? If the answer is no, then that's your most important job as a trader.
All right, let's get right into it. What really separates the traders who make it from, well, everyone else? You know, is it some secret indicator, some hotline to a Wall Street guru? Nah, it's almost always something way less flashy, but man, is it a heck of a lot more powerful. I'm talking about meticulous record keeping. Today, we're going to break down exactly why this is the secret weapon for building the kind of discipline you absolutely need to win in this game.
This quote from Andrew J. Mellon, it just nails it, doesn't it? In trading, there really is no free lunch. You either put in the work up front, the preparation, the documentation, or you're going to pay for it later. And you'll pay for it with bad trades, with emotional mistakes, with losses. Being disorganized in the markets is like a hidden tax on everything you do. So think of good records as your investment in future profits.
And here's where it gets really, really tricky. The market is kind of messed up sometimes. It works on what's called random reinforcement. I mean, you can make a totally sloppy, impulsive trade and boom, you get lucky and make a huge profit. And then the next day, you can follow your plan to the letter, do everything perfectly, and still lose money. That right there is the psychological trap that just chews up and spits out even the most well-intentioned traders. It's why having a structured system isn't just a nice to have, it's a matter of survival. So, how do we fight back against this chaos? Well, we're going to walk through the entire playbook of a disciplined trader. We'll kick things off with the daily homework you gotta do, then we'll check in on your mindset. After that, we'll get into a system for objectively scoring your trade ideas. And finally, we'll talk about the ultimate learning tools, your trade journal, and how you review your trades. Okay, first things first. Let's start right at the beginning of the day. The very first thing a disciplined trader does is their pre-market homework. Look, this isn't about finding some hot stock tip. It's about getting your head in the game and syncing up with the market's pulse before the chaos of the opening bell begins. Now, I know what you might be thinking. A spreadsheet? It looks kind of simple, maybe even a little basic. But think of it like your morning routine. You know, brushing your teeth, making coffee. You don't think about it, you just do it. Automating these little checks gets you in the zone, and it frees up your brain power for the big strategic decisions later. It is literally a pilot's pre-flight checklist for the trading day. And the best part? This whole process takes maybe 15 minutes, tops. It's a quick, systematic scan of what's driving the market right now. You start by seeing what happened overseas, in Asia and Europe. You glance at the economic calendar to see if there are any big reports that could cause some fireworks. You check in on stuff like oil and gold, and key gauges like the VIX, the fear index. Then you put it all together and ask yourself, okay, what's my bias for the day? Am I going to be aggressive, or am I going to play defense? Okay, so you've analyzed the market. Awesome. But what about the single most important and most volatile part of your entire trading system? Yeah, that's you. This next part is all about checking in with yourself to see if you're actually ready to trade.
And you've got to be brutally honest here. I mean, are you trading while you're sick? Are you stressed out because you've got a big meeting later? All that stuff, it bleeds into your trading performance. You can't just pretend your life outside the market doesn't exist. Trying to trade when you're distracted or angry, well, that's just a recipe for losing money.
Look, we're all great at lying to ourselves. Oh, I'm fine, I can trade. That's why you need an objective tool to cut through the noise. This little psychological self-test takes, 30 seconds? But it gives you a stone-cold, honest look at whether you're actually fit to be putting on risk. It covers how you feel physically, how you did yesterday, how prepared you are, your mood, and what your schedule looks like.
And the scoring gives you simple, non-negotiable rules. A 4 or lower? That's a red light. Don't even think about trading today. Just walk away. A 5 or 6 is a yellow light. Be careful, maybe trade smaller. 7 to 8? That's your green light. You're ready to rock. But here's the really interesting part. A 9 or 10 is also a yellow light. Wait, what? Shouldn't that be great? Nope. That's your overconfidence alert. That feeling of being invincible? That's when you're most likely to do something stupid.
So, you've done your homework, you've checked yourself, and you've got the green light. Now for the moment of truth, objectively grading your trade idea before you put a single penny on the line. Now, the inspiration for this amazing tool comes from a place you'd probably never expect. A hospital delivery room. Back in the 50s, a doctor named Virginia Apgar created this super simple 5-question test to check the health of newborns. It was fast, it was objective, and it literally saved lives by helping doctors figure out which babies needed help right away. We can steal that same brilliant logic for our trades.
But here's the twist, and it's a huge one. A doctor uses that score to find the weakest babies and focus all their attention on saving them. As traders, our job is the exact opposite. We use our trade Apgar to find the strongest, healthiest, A-plus trade setups, and we ruthlessly throw everything else in the trash. We are not here to be heroes and rescue bad trades.
So what does this thing actually look like? Well, here you can see 2 examples for a particular strategy. There's one for going long, and its mirror image for going short. Each one asks 5 specific questions about the trade setup, and you score each one from 0 to 2. The whole point is to take that vague gut feeling you have about a chart and turn it into a cold, hard number.
And that number leads to one simple, powerful rule. We only take trades that score a 7 or higher. That's it. But there's a catch, and it's a deal breaker. If any single one of those 5 categories scores a 0, the trade is dead on arrival. I don't care if the total score is an 8. If a key ingredient is missing, the whole thing is off. This one little rule forces you to filter out all those tempting but flawed setups and wait for the best of the best.
Now that Apgar score is really just the first hurdle. It's the gatekeeper. If a trade passes, it gets to move on to this larger document we call a trade bill. You can think of it like the shipping manifest that travels with the package. It has everything you need to know: your exact entry, your target, your stop loss, your position size. It is the complete blueprint for that trade, from start to finish.
The plan is made, the trade is on. So, we're done, right? Time to kick back? Not even close. In fact, maybe the most important part of the whole process is just getting started. And that's learning from what just happened. This is where your trade journal becomes your best friend.
I just love this phrase, extracranial memory. It's perfect. It's like an external hard drive for your trading brain. Because let's be honest, our own memories, they're not that reliable. We tend to remember the glorious wins and conveniently forget all the painful losses and stupid mistakes. Your journal, it doesn't forget. It's the objective truth, the raw data you need to find your edge.
And a good journal is way more than just a list of your P&L. A structured journal forces you to document the why. Why did you get in? It makes you actually save the chart so you can see what you were thinking. It makes you explain why you got out. Was it your plan, or did you panic? And most importantly, it's got a space for you to analyze the trade later. That's where the real gold is hidden.
The payoff for doing this comes in waves. The first one is immediate. Just the act of writing everything down brings this incredible sense of order and control. The second benefit comes later, when you start reviewing and have those big aha moments. And the final payoff, the big one, comes when you have enough data to really dive deep and figure out what's actually working in your trading.
So, let's tie this all together. All these things we've talked about, the homework, the self-test, the trade bill, the journal, they aren't just a bunch of separate tasks. They all feed into each other to create this powerful feedback loop that constantly pushes you to get better and better.
And now for what might be the single most powerful learning hack of them all. You have to review your trades 2 months after you've closed them. Yeah, 2 months. Why? Because it's the perfect amount of time. The chart has had time to fully play out, and your emotional baggage from the win or the loss has completely faded. And all of a sudden, a signal that looks so confusing at the right edge of the screen becomes crystal clear when you see it with the 20/20 vision of hindsight.
For example, take a look at this review of a short trade. When you look back 2 months later, it's so obvious that the entry was perfect and the exit was perfect. The whole thing played out exactly like the textbook says it should. Now, the lesson here isn't complicated, but it's absolutely vital. This is what builds deep, real confidence in your system. It teaches you to trust the pattern next time you see it.
But the lessons aren't always about patting yourself on the back. Check out this trade. The trader snagged a small, quick win. Looks pretty good, right? But the review 2 months later showed that they bailed out right before a massive downtrend resumed. So even though it was a profitable trade, the review uncovered a major weakness. The lesson: just because you close a trade doesn't mean you should stop watching it. Sometimes the real opportunity is just around the corner.
Ultimately, that's what all of this is about. All this record keeping, all this work, it transforms you. You stop being a gambler just pulling a lever, and you become a professional student of the markets. Your trade journal becomes your own personal mentor, a teacher who knows you better than anyone else. It's going to show you your strengths, it's going to shine a big bright light on your weaknesses, and it's going to guide you. The only question left is, what will your journal teach you?